Welcome to the Three Questions Webcast series. I'm Wayne Baxter, Senior Executive Manager with One Capital Management. On this episode, we're going to share with you the three questions cross-border investors should ask before changing their current investment strategy. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions Webcast series, please consider liking this video and subscribing to our YouTube channel. Clients are often referred to as cross-border clients. U.S. or Canadian residents who invest in U.S. and or Canadian dollar denominated securities like stocks, bonds, and ETFs. At One Capital Management, we develop and implement strategies for our clients which strive to grow, protect, and ultimately distribute their wealth, and we do that by offering investment wealth management services. Our process for advising our clients includes an in-depth discovery and diagnostic analysis of their wealth management goals and objectives, and needless to say, that will include an in-depth review of their investment strategy. For many clients, we allocate a portion of their portfolio to bonds or bonds ETFs. With the rise in interest rates over the past 12 months, investors are being rewarded with much higher yields. It's only reasonable that some investors may be inclined to reduce their equity exposure and increase their fixed income allocation. Is this the right strategy? We're going to explore some of these risks. And on this episode of the Three Questions Webcast, we're going to talk to one of our portfolio managers here, and we'll continue that discussion. On this webcast, we'll be reviewing the three questions cross-border investors should ask before changing their current investment strategy. And joining me once again is Lance Messervy. Lance is a director and a senior portfolio management here at One Capital Management, and he's a member of One Capital Management's investment committee. Lance, thank you so much for making time. I know you had a really busy schedule. Thank you for taking time to joining me today.
Appreciate it, Wayne. Thank you for the opportunity. I'm happy to have you bring me back on.
Yeah, for sure. Well, before we get to our three questions, I'm really interested to know if and how the investment committee's view of the global stock market, and specifically, the opinion has changed at all in terms of owning stocks, given the fact that yields have increased and investors are enjoying much higher yields on their portfolios. And also, not to mention the fact that we have, global conflicts in the Middle East and in the Ukraine. Has the committee's opinion of equities changed at all in any way?
Well, what I would say is probably, first of all, there is a lot to unpack in that question. So we'll hop into probably a little bit of the conflict up front. But I would say high level answer, our position on equities is definitely from a long-term investment time horizon. So not as significant as one might think with all the turmoil that we're seeing and facing right now, right? So basically, let's kind of unpack the part about, the events going on in the Middle East, right? We believe that those events in the Middle East should not have a significant impact on the markets. We kind of saw a preview of this, let's call it last year, with Russia and Ukraine, right? There was actually really little impact on the markets during that conflict. Kind of what we expect to see in the Middle East, and with what's going on right now, is we assume that it'll follow a similar path or trajectory. So that would really be our view on that. What I would say also, though, is something that could probably change that significantly would be if you saw like Iran and Russia. If they joined in on the conflict, then probably what you would see is a short-term spike in oil. And then eventually, probably over 12 months after that, you would kind of expect to see the price of oil fade back and fall back into its equilibrium pattern. So while I guess I would say it's definitely devastating and tragic, right? What's going on in the Middle East.
Absolutely.
We don't see it having a major impact on the markets. I will throw out the caveat: if it became a global world war, that's a different story. But if it is self-contained within the Middle East, then that's pretty much our view, and that's what we expect, should be the outcome. So as far as like 2023 and beyond, where we're headed, what we're thinking, I probably would say it's probably appropriate to take a quick step back and look at what we saw in 22, because 2022, honestly, that was an anomaly and it was very abnormal. And I'll kind of throw some data at you to give you an idea, but I mean, we really haven't seen anything like that since 1969, where the fixed income market and the stock market both had such
double-digit negative returns.
That's right. So basically, let's just say this. In 2022, what we saw is extreme erosion in the value of bonds, and that actually helped investors for 2023 because bond investors, now they're basically receiving more attractive interest payments going forward because of the interest rate hikes. I mean, to put it in perspective, at the beginning of 2022, a 6-month treasury bond paid an interest rate of 0.22%. That's 0.22%, right? The same bond today pays about 4.76%. Significant increase, right? But also we know how bonds work. Price goes up, right?
Yields go down and vice versa.
Yields go down and vice versa. And so what we saw is significant increase in interest rates and the bonds tanked, right? So
that's the right word last year. Anyway, if you were holding longer duration bonds, that was
if you can believe it, Wayne, in 2022, bonds were down in aggregate, bonds were down 13%.
100%, more than
right?
That's overall, yes. Aggregate bond. Thankfully, our clients didn't suffer the same way, but 100%.
That's right. That's right, because that's aggregate. It's a much longer, duration portfolio. So bonds that go way out longer in the curve. Our clients at that point were about 2.5% duration. So they actually weathered the storm pretty much better than 95% of the market. But even looking at the S&P 500 in 2022, negative 18%. Now you flip the script in 2023, bond market still, because of interest rates going up, over that time period, it's still probably relatively flat, but the S&P 500 is up 15.5%. So what I would say is very, very challenging, trying to time the market, but definitely including bonds in your investment mix makes a lot of sense, especially when interest rates are continuing to rise. Because the bond interest rate component that's probably most significant is the key aspect of is within total return is you have this higher interest rate payment from a coupon that you're receiving, which basically is a great insulator as bonds start to increase, right?
Absolutely. You're getting incredibly much bigger reward than you were, a year ago. You can't even compare. So absolutely.
Absolutely. So all in all, in a diversified portfolio, we see that in 2023, you're still going to have positive returns. It's still going to move forward. You may find that as we ticked up, in interest rates over the last 16 to 18 months, we may get one more, but we're almost at the peak. And basically at that point, if you stay flat for a little bit, that's okay. We're now earning higher interest rates on the bonds we do hold. And you will start to see that interest rates will taper off as the economy, or let's call it as, the Fed looks at interest rates and the economy and says, okay, now we can pull back a little bit. And if we're in a position where we're extending duration, which we would be, then those bonds with a longer duration are going to start to outperform. So,
yeah, well, I guess that leads me just to think about our clients' bond portfolios. We saw last year. I mean, you encapsulated it really well. The bond market was significantly impacted when the price of bonds, when the yields on bonds, or when interest rates on bonds go up significantly, so that the price goes the other direction. Now we're sitting here this year, we actually, our clients didn't do so badly because we kept duration pretty short.
Yep.
That helped offset that risk that we saw. Given the current environment, what is the investment advisory committee comfort level as it relates to duration on our clients' bond portfolios? And in that range of the duration, what is a realistic yield for them to expect going forward, at least for the near term?
Yeah. So where we went, where we were at a 2.5 duration, we are now starting
2.5 to 3.5 year duration. Yes.
Yep. We're starting to extend that out stepwise, basically at 25 basis point increases. I would expect us to go up to, a 4.5, potentially 5, maybe by the end of the year. Just dependent on market conditions and how we continue to move forward. But But that would basically extend us out so that when rates do go down, we'll be able to take advantage of that. We're never going to be extremely long. We're never going to go out 10, 15-year duration. That's just too much risk to add into a fixed income portfolio, which we want to use as a ballast to diversify and reduce overall risk. We don't want to take that kind of outsized risk on our fixed income. So we would probably be, I'd say 4.5 to 5. And what you would expect as far as a rate of return, I'd say it would be fair to say around a 6% on your fixed income portfolio. Now, if interest rates start coming down and we're out a little bit more, I mean, you could definitely actually get more than a 6% once you bake in the price improvement, the price return itself.
You're going to have the price increase because of interest rates coming down and the yield on top of that.
That's right.
So but I mean, you're expecting a yield of around 6%. And on top of that, depending on what happens with interest rates.
That's a great way to frame it. The interest rates going down, that price improvement will be gravy, but we're expecting a 6 more or less going forward.
Well, you and I could spend the next 45 minutes here talking about the bond market, and our friend Randall Curtis would feel rather put out if we did, since he's the deputy chief investment officer responsible for fixed income. So we'll try to go away a little bit from the bond market discussion, and we'll get right into the 3 questions that cross-border investors, U.S. or Canadian investors, should ask before changing their current strategy. And the first question is this: number 1, while my investment objective hasn't changed, given the rise in interest rates earned on bonds, should I increase my bond exposure and reduce my equity exposure?
It's a great question.
Lance, what say you?
That's a great question. And I think that a lot of people are asking that. And honestly, it seems really enticing to do so, right? What I would probably say to that is, the Nobel Prize winning economist, Harry Markowitz, called diversification the only free lunch in finance. Bonds have played an essential role in diversifying investors' portfolios and helping them to mitigate their portfolio losses during periods of negative equity returns. And we believe that's going to continue to play a valuable role in offsetting losses over the long term. So diversification is back, baby, for sure. And 2022 was a highly unusual year. Over the long term, bonds should continue to be a great diversifier to equity stress. I would say diversifying your portfolio across stocks and bonds can help you lower the overall risk and reduce volatility. When you may be tempted to abandon, this is where we're going to answer the question, when you may be tempted to abandon your investment plan in favor of market timing moves, it's important to remember that sticking to your asset allocation is often the best strategy for keeping your long-term goals on track. Our investors generally, and this is what we built the strategy for, right? Are long-term investors. And long-term investors don't jump in to an investment strategy without an actual plan that they plan on holding throughout their investment horizon. So what I would say is, even if bonds may seem attractive right now, that doesn't mean long-term investors should abandon, let's say, even an all-stock portfolio in favor of adding bonds, even though they look so enticing. While the bond market suffered in 2022, so did the tech stock heavy NASDAQ. And that had even greater potential for long-term returns. So I guess I'm really just saying that you have to factor in the opportunity cost of leaving the equity market in favor of bonds. And if you chase performance, you might end up shooting yourself in the foot. In other words, if your original plan didn't include a high allocation towards bonds, I honestly wouldn't include them now. I wouldn't change the asset allocation. I think once you pick your asset allocation, unless something changes with your goals or your investment time horizon, you stick to your current asset allocation, right?
100%. You're preaching to the choir.
Yeah.
100%. It reminds me of a mentor of mine many years ago. I say that reluctantly, but many years ago, said to me, he says, Wayne, market timing is death.
Yep.
So, but I'm really interested in from the standpoint of the committee's point of view, and great to see that hasn't changed. Okay, so great answer to question number one. Question number two: is there a minimum I should have before investing in individual stocks? I keep hearing that owning individual stocks is better than owning mutual funds. Your thoughts? Is there a minimum amount? And again, we'll use context here. Think about it from the context of a globally diversified portfolio that you would put together for a client.
Yeah.
We're not talking about owning one stock. We're like, think about it in context of a fully diversified portfolio.
Yeah. I guess what I would say there is, we run full equity strategies and which hold individual stocks.
Right.
And generally, we just call it at a 60-40 asset allocation, 60% in equities, 40% in fixed income, a pretty generic balanced portfolio, call it. We would recommend the portfolio size be about 250,000, right? That equates to about 150,000 in equity, so stocks, and 100,000 in fixed income. That gives us the ability to diversify well enough within the individual stocks in the portfolio that it's a good, let's say it's well diversified, right? You're not taking any too much single name exposure in any one stock. That being said, I think the biggest difference in owning individual stocks versus mutual funds is what we're alluding to right there, and that's individual stocks carry more unsystematic risk, right? So systematic risk, just for people that may not be familiar with those terms, I'll just give you a quick definition. Systematic risk refers to the risk inherent to the entire market or market segment. This systematic risk also is known as like undiversifiable risk, volatility risk, market risk, and it's basically effects from the overall market itself. When we say single stock risk or unsystematic risk, we're talking about what's applicable to one company. Like, what are the factors, that impact Apple or the tech sector itself? And so I would really say the reason to own individual stocks, and this is why we do it in our discretionary portfolios, is to manage more fine-tunedly and personalize the tax management side of it. So to manage your tax liability. The next is to control the portfolio risk more precisely. So when we do select the individual names, even though we're diversifying it, we're selecting them based on a risk return profile that we're more comfortable with than just owning a broad basket like a mutual fund. And then, just the desire to more reliably control like the income stream, right? Because you're getting paid from dividends. If you own fixed income, that the interest coupons you're getting paid. So you can more finely control that. So that's what I would say is the most important thing is once you hit a level where you have a significant amount enough to invest, you have a lot more control when you invest in individual stocks.
And it's great for tax trading, as you were mentioning, for tax loss harvesting opportunities. Okay, very thoughtful answer, Lance. Thank you. For the third question, and this is kind of an offset of the question number two. I'm interested to see how you respond to this. Am I better off owning an individual bond that pays a higher yield or bond funds? And I'll even include in that bond ETFs.
Yeah, that's a great question. So what I would say, short story, bond valuation is pretty clear and bond math is pretty consistent. And the answer would be, I guess, no. You wouldn't necessarily be better off as a short answer. Let me give you the long version real quick, and it'll help kind of explain it more. I would say,
so no to owning an individual bond versus a bond fund or bond ETF.
Yeah, not really. Okay. I'm going to just lay out the case for you real quick. Against holding a portfolio of individual bond securities. And this will maybe paint the picture a little bit better. I would say if you buy an individual bond from a broker and hold it to maturity, you will receive regular income payments from the bond, on that yield when you bought it. Then at maturity, and this is usually what the bondholders like and why they want to own the individual bond. at maturity, you'll receive your full principal back, right?
Mm-hmm.
And so that's what you hear constantly. Like I at least know that at the end of my bond's life at maturity, I'm going to get my principal back, and I can count on that. And basically a bond, it's simply a debt instrument. So that makes sense. So let's just put a little bit of numbers around that framework to kind of let us understand a little bit better. Let's just say you bought a bond for $10,000, and it was a 5-year treasury, and that treasury yielded 4%. You would receive $200 every 6 months, and in your initial layout to buy the bond, your initial purchase price, the 10K, you get that back at maturity in 5 years. So it's simple enough. The reason many people like holding individual bonds is what we stated earlier, and that's because they know exactly when.
It's very predictable.
Yeah, it's very predictable. They know when they're going to get their money back and how much. So even if rates move up or down in the meantime, you can wait out those fluctuations and still receive your par value at maturity. Now, the crux of it, though, is after experiencing big losses like we saw in 2022, many investors really end up going, hey, now I'm wondering, would I have been better off holding? This is why you're asking the question. Would I have been better off holding an individual fixed income or pieces of fixed income or a bond fund itself? And the reality is it honestly wouldn't have mattered. And so basically a bond fund is literally a fund of individual bonds. So you could either hold an individual bond or you own a fund that holds individual bonds, but the bond fund itself is mark to market, every day. So the pricing's the same. It just, you see the pricing fluctuation, which you don't see in that individual bond if you're not watching it every day, right? So really you can basically say, you're getting your money back at maturity, which might be like an emotional hedge, I guess you could say. But it doesn't actually make you any better or worse off in the end. So when rates go up, the value of the bonds, they go down when you're holding an individual bond or whether you're holding a bond fund. So
you're going to have the same experience.
You're going to have the same experience. Honestly, it really doesn't matter in the end, because probably the easier way to look at it too is through another quick little example. And that would be, okay, let's say you own a bond fund and that yield, on the bond fund when you bought it was 2%, right? We own individual or a bond fund ETF. If it goes up to 4%, that bond fund price value goes down. But let's say the duration, right? So we moved from a 2 to a 4. If the duration of those bonds in the fund is 5 years, you would expect basically the bond fund to fall about 10% in value. And that's not fun for anybody. But for the sake of this example, let's say you decided to sell your bonds, the bond fund itself, and then buy all individual bonds, right? In that fund, which now collectively yields 4%. So you basically you potentially harvest a loss. So that's actually a value add, but you sold and bought a new bond fund at 4%. And now you're earning the higher interest rate, but you've taken this loss and basically kind of crystallize it.
Tax loss harvesting, which is, right. To me, that's one of the benefits of strategic asset allocation is the ability to buy into the bond market in the years when equities are rallying, and basically selling your bond positions when the stock market is. I know last year was the anomaly, right? Thankfully for us, we kept our duration short, so we didn't experience a double-digit negative rate of return like the aggregate bond index did. But the ability to buy into the stock market by selling off some bonds exposure to your bond ETFs when markets are I guess you could say correcting the stock market. So I would think that if you're holding a bonded duration, a single bond position, that might be a little bit of a more challenging decision to make than it would be if you're owning a basket of bond ETFs.
Absolutely, for sure. I mean, think about it this way too, is, if you held on to an individual bond and that bond was paying 2%, right? It was, you bought it when rates were 2%, and then now rates are 4%, you're basically, losing out on 2% the whole time you hold it till maturity. Mm-hmm. And then imagine a scenario like what we have now. Interest rates went up, right? Inflation went up. So when you got that return of principal at the end, it's actually worth a lot less than when you bought it, right? Mm-hmm. Because of inflation. And so the bond math, it always makes sense. It always lines up. And that's how bonds are priced, right? So you either take it on a fund, an ETF, rebalancing and managing the process and getting new bonds in there that are paying higher interest rates. And then you get to experience the higher interest rates going forward. Or you lose out on the front end and have to pay for it on the back end when you get your maturity that's worth less, your principal.
I think it's pretty clear. It's pretty clear, and just to summarize is that you give yourself a lot more flexibility when you own a basket of bond ETFs or bond funds than you do if you own an individual position. I think that's the absolute number one conclusion. I would always say, when it comes to making investment decisions, there's some basic rules of thumb. And I think, and you alluded to it earlier, Lance, and that is, first of all, there should be a written plan. There should be a cash flow planning, capital forecasting. That really can help determine things like spending rates, how hard your portfolio needs to work, what kind of yield you need. So that's really, I think, rule number 1A, start with a game plan. And that game plan shouldn't really be impacted by, short-term events that occur in the global markets, you see world events, like that kind of stuff. We should have a long-term plan. And then your bond and stock portfolio, your stock and bond portfolio should be allocated according to that plan. And then ultimately you should stick to it, right? Stick to that plan. What should cause a person, I believe, in my experience, is if your personal financial situation changes, birth or death in the family, hired or fired, married, divorced, that sort of thing, receive an inheritance, those sort of things, they can obviously have an impact on your financial planning and could cause you to want to change how your allocation of your money should be set up. But avoiding making emotional decisions because of what you watch on TV or see on the internet or listen to on the radio would not be advisable. And I really just want to thank you, Lance, for making time for us today. We covered a lot of ground. Really appreciate it. Took your time on a very, very busy day here. So thanks very much.
I appreciate it. Thanks, Wayne.
Thank you very much, Lance. Lance Messervy is a senior portfolio manager here at One Capital Management. I look forward to bringing you the 3 Questions webcast and hope you find them educational and informative. Please consider liking this video and subscribing to our YouTube channel. And to receive a notification of when our latest webcast is being posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below. And that's www.onecapital.com/meetwithwayne. Thank you and see you soon.